I'm wondering, given, I mean, a month ago, we actually would have had a slightly different conversation about bonds because, of course, bond yields have jumped so substantially, especially at the short end over the last 6 or 8 weeks, but they're still low historically. And I'm just wondering, I think a lot of people are wondering whether bonds still have a place in a long-term strategic asset allocation. And if so, how should investors think about bonds right now?
Yeah, okay. So first, I do think they have a role, and obviously for somebody who has got liabilities, like there's liability matching, but there's also the diversification argument, which, like negative stock bond correlation has been very helpful. We'll soon write about something, whether that's likely to continue. But in general, like if you think of sort of macro diversification, there's really nothing else that helps if you get a scenario of deflationary recession, and or 2008 repeat or something like that. I think it's pretty or highly unlikely in the current situation that we'd get there. But in an uncertain world, I'd like to have something for that particular scenario in the portfolio. So I do think that even with the expensiveness of govies, it's there. And obviously yields have risen a lot, and so I'll get to that in a moment. But in general, bond yields, you think of there's the cash part, and then there or expected cash return, and then there's required term premium. And I've written about both, and I think like all of these have led to these very low yields that we have seen in recent years, even negative in many countries. So there are savings glut type of explanations why real cash rates are so low, and sort of central banks have, I would say, they haven't led that, they have accommodated to that reality. And then when you think of term premium, like in my mind, it's sort of driven mainly by inflation risk premium, the safe haven premium due to negative stock bond correlation, and supply demand factors like a QE, and all of those pushed yields low, and now all of those might be pushing yields higher, and so it's an interesting situation, and it is not relevant only for bond investors, it's relevant for everybody. So in some way, the key theme there is, why is everything expensive in this world? It is because all long only assets, also equities, illiquids, and so on, they are priced as if by looking at expected cash flows divided by discount rate, which contains the riskless part and some diverse risk premia. And when that common part of the discount rate is so low as it has been, that makes everything expensive. That's the big background story there. So that has justified the expensive valuations for everything, meaning that basically equities have their starting yields as low as we've seen real estate as well, and so on. So, and that justification, it's fair, but it sort of means that we should really expect those lower expected returns in the future. But it also says if bond yields, and especially if real yields, more real yields than inflation, if real yields start to rise from here, that's going to hurt so many assets. And that it may be that it's going to prevent real yields from rising too much, because again, that would be too painful. Anyway, so my main point, it's not only about bonds, and what happens to bonds doesn't stay with bonds only. Actually, in the last few weeks, equity markets seem to act as if they could ignore it. But this is a very short term and not related to my books, Long Horizon and Humble Approach. But I really think that's a unreasonably optimistic stance that equity markets were taking in recent weeks.